Assalamualaikum. Welcome to lecture 5 of financial reporting, that is IFRS 15. So in IFRS 15 onwards, that is lecture 5 onwards, we are going to focus on each individual element in your financial statement. So the first element we are going to pick is the revenue. Okay. So in this lecture, revenue from contracts with customers. How we are going to recognize this in the financial statement. So let us go through this. Under this, the principles of recognizing revenue. So what IFRS 15 says, you have to identify your contract with customer, identify performance obligation, determine transaction price, allocate transaction price, and recognize revenue. These are the 5 steps in recognizing revenue, and you will be asked questions on these 5 steps. Okay, you can be asked questions on any of these 5 or maybe all 5, but you have to know under each of these 5 what you're supposed to do. For example, how do you identify contract with customer? How do you allocate the price? How do you identify performance obligation? How do you recognize revenue? Then we are coming to the revenue recognition. You recognize revenue over a period of time or at a point in time. This is depending on, are you satisfying your performance obligation over time or at a point in time? And measuring progress towards completion, there are various methods to do that, which we are going to study. Then how do you recognize the contract cost? See, the title of the standard is revenue from contract with customer. If there is a contract, there will be cost also. So that contract cost also you have to take into account. You have to recognize it. Number one, the types of the contract cost, incremental cost of obtaining and cost to fulfill a contract. There are two types. One is incremental, one is cost to fulfill contract. Then the loss-making contracts. Coming to the contracts with customers in your statement of financial position. So when the parties perform, how do you record? And the balances in your statement of financial position. Then specific transactions. So these are the 4 specific transactions. Principal versus agent. If you are principal, how you will recognize revenue? If you are an agent who is selling on behalf of principal, how you will recognize revenue? Next, repurchase agreement. Under repurchase agreement, how you can recognize revenue? Then for bill and hold arrangements, how you will recognize revenue? And for consignment. And finally, we'll see which part of the syllabus we have covered from this lecture, summarize the entire lecture, and whether there are any technical articles you have to read for your revenue. So the main objective of this lecture is to understand the principles of revenue recognition and how it can be measured. Before I start, let me tell you 2 very important things about IFRS 15. First one, the good thing about IFRS 15, it did not change from your previous syllabus. So IFRS 15, whatever I have taught before, in my SBR you must have seen, I've done IFRS 15. It is the same. There is no change in IFRS 15. Whatever is there, it's there. Because one might be thinking, since new standard came, IFRS 18 came, which has replaced IS 1, whether it had any impact on revenue or not. No. Yes, maybe the name, the title, since now the profits, if you recall IFRS 18, now your profit, your income and expenses are divided into 5 categories. Yes. Now when you recognize the revenue, maybe it might fall in the operating, investing, financing, income tax or discontinued activity. That change, that name change is there. But other than that, technical area, everything is same. That's a good thing. Okay. Next, IFRS 15, you are definitely going to get in your exam, whether it is SB or whether it is FR. IFRS 15 is so important. It is a very important standard. I always tell students that don't go to your FR exam without the knowledge of IFRS 15, because IFRS 15, 100% it will be tested. Okay. So those were the 2 important things. Now coming back here. So these were the things we have gone through. We'll go through the principles of revenue recognition, the 5 steps in revenue recognition. And then how do you recognize revenue over time and at a point in time, and measuring progress towards completion to recognize the revenue, because it's a contract. See, contract takes a long time, so you need to know how you are going to recognize revenue over a long period of time. For that, you have to measure your progress. How much you have completed, based on that only you can recognize revenue. Then, how it will be recorded in your statement of financial position. And then we recognize the contract cost, incremental, fulfill, and loss-making contract. Then the 4 specific transactions. Okay. So these are the things we are going to cover, starting with the very basics of IFRS 15. IFRS 15 outlines 5 steps of a revenue recognition process. First step, identify contract with customer. There should be a contract with the customer. Without the contract, you can't apply IFRS 15. So in your exam, you have to see whether there is a contract with customer to give a good or service. Step 2, identify separate performance obligation. I was talking about whether there is any obligation that you are supposed to do. For example, you're supposed to you promised, or there is, you are supposed to give a good under the contract or a service. Okay, sometimes it would be one, sometimes it would be more than one. Step 3, determine the transaction price. There should be a price set to it. 4, allocate that price among the various performance obligation if there are more than one. Then step 5, recognize revenue over a period or at a point in time. Now, the core principle of IFRS 15 is that entity recognizes revenue from the transfer of good and service to a customer in an amount that reflects the consideration that entity expects to be entitled to in exchange for goods and services. That means from the moment the seller, the entity, is transferring the good and service to the customer, they can recognize the revenue from that point onwards. Okay, so for transferring that good and services, in exchange they are going to get an amount, a consideration. That is your revenue. That is your revenue. Now, first step, contract. What is a contract? An agreement between 2 or more parties that creates enforceable rights and obligation. Customer, a party to a contract who is going to obtain those goods and services. Okay. So for that, in return, customer is going to pay to the entity some amount of consideration. Now, so revenue recognition principles of IFRS 15 applies only when the contract meets all of the following criteria. First one, parties to the contract have approved the contract either in writing or oral, or it's an implied by customary business practice. Next, entity can identify each party's right regarding goods and services. Payment terms has been identified. Contract has a commercial substance. That means there's a risk to it. Timing is there. Amount, future cash flow, they will change because of the contract. Your risk will change, your timing will change, amount of future cash flow will change. All this has to change. That is the meaning of commercial substance. And it is probable entity is going to collect the consideration under the contract. So all these 5 points has to be there. Then only you can recognize revenue. If one of the 5 things is absent, you can't recognize revenue. These criteria are assessed at the beginning of the contract, not during the contract or after the contract, before you start the contract. If met, then you don't have to reassess. Okay, you only have to meet it once before the contract, unless there's an indication of significant change in facts and circumstances. Next, if it is not met initially, then you should continue. They should continue to be assessed to determine whether they are subsequently met. If not initially met, you have to see whether subsequently they are meeting the 5 criteria. Okay, if they are meeting subsequently, you recognize revenue. If they are not meeting subsequently also, do not recognize revenue. Now, second step, performance obligation. What is performance obligation? It's a promise in a contract to transfer a good or service to the customer. Okay, or a bundle of goods and services, or series of goods and services that are substantially the same and they are transferred in the same way. You are transferring in the same way, goods and services are same, but in a series. Rather than giving it at once, you are giving in installments. It is performance obligation. So If a promise to transfer goods and services is not distinct from the other goods and services in the contract, then the goods and services are combined into a single performance obligation. If they are distinct, you can't combine, they are different. Okay, but if they are not distinct, you can combine them. Now, a good and service is distinct if if both of the following criteria are met. What are those two criteria? Customer can benefit from goods and services on its own when combined with customers' available resource, and the promise to transfer the good and service is separately identifiable from other goods and services in the contract. In this case, they are distinct. Now, factors that indicate the promise to transfer goods and service is separately identifiable include that goods and services is not integrated with other goods. That means it is not an input to deliver a combined output, or it does not modify or customize another good or service, or does not highly depend on or relate to other goods or service promised. Now, example 1, Tanner. Tanner is building a multi-unit residential complex. He is entering into a contract with customer for a specific unit that is under construction. So the contracted for goods and service includes procurement, construction, piping, wiring, installation of equipment and finishing. Okay. What is the analysis? See, although the goods and services, okay, provided by the contractor are distinguishable. You can distinguish construction from piping from wiring, but they are not distinct in this contract. Why? You can't identify these goods and services separately from the promise to construct the unit. To construct the unit, you need procurement, you need the construction to be done, you need piping, wiring, installation. Separately, you can't sell them. Okay, so Tanner will integrate all these goods and service into one unit, even though you have promised in the contract that you are going to give piping, wiring, installation, but you can't combine them. You can combine them into one unit. They are not separate. So therefore, this is the all goods and services under this contract, that is construction, procurement, piping, wiring. All this is a single performance obligation, that is to transfer specific unit. Okay. Now, example 2. This is about software developer. So software developer Jackson is entering into a contract with a customer to transfer a software license, perform an installation, and provide software updates and technical support for 5 years. How many things are there? License, installation, update, technical support. 4 things. So Jackson can sell the license, installation, update, technical separately, isn't it? So in this case, Jackson can determine each good and service. They are separately identifiable because installation will not modify the software and software is functional without technical and update also. If one thing is independent, it's not dependent on another to run, they are independent, like in this case. But in the previous case, for that unit, you need wiring, you need procurement, you need construction. They can't be run on its own. They have to be combined, then only you can create that unit. You understand? But in this case, it is not so. Therefore, here it can be separate. So, analysis, that is the answer, is that the software is delivered. You can deliver the software before installation, updates, and technical, and it will function also. And customer can benefit from each good or service individually. So in this case, Jackson has determined that license, installation, update, technical support, these 4 things are separately identifiable. So there are 4 performance obligation in this contract. In your exam, always check to this, how many performance obligations are there. Sometimes if you are lucky, they will give you one. Okay, I'm saying lucky because it's easier to work with one. And often students, if it's given more than one, it's difficult to identify whether you can combine them or they're separate. That's why I told, if you're lucky. Okay. So in this case, it's 4. What are the 4? License, installation, update, and technical. Now, determining the transaction price, the third step. What are the considerations when you're determining transaction price? What is the meaning of transaction price? Let us first understand that. The amount of consideration to which an entity expects to be entitled in exchange for transferring goods and service, promised goods or service to a customer, excluding the amount that is collected from third party, example sales tax. If there is any sales tax, ignore it. Other than that, see, this amount you must have promised in the beginning of the contract. That is your transaction price. That this, if this contract is finished by this time, this is the amount I'm charging. So the effect of the following must be considered when you're determining transaction price. 9.1 is time value of money. Because contract, it takes a long time. Today you are setting a price, but by tomorrow, because of inflation, the value will go down. So that's why time value of money you have to take care. And if the contract includes a significant financing component. Next, fair value of any non-cash consideration. Your consideration could be non-cash also. You have to take the fair value. Then estimates of variable consideration. Yes, when you're taking consideration and if it's variable, you have to make an estimate. Consideration payable to the customer. What do you have to pay to the customer? How you account for it? So any consideration that is payable to the customer will be deducted from your transaction price unless it is for the goods and services received from the customer. That means if you are receiving any consideration from the customer for the goods and services that you are going to give them, then you don't reduce it from the transaction price. Otherwise, other than that, any consideration payable from the customer, deduct from the transaction price. Now, second, significant financing component. The contract price includes a significant financing component if the seller receives the payment from the customer at a time that is sufficiently before or after the satisfaction of performance obligation that the time value of money is significant. Okay. See, financing component means seller is receiving the payment from the customer before or after satisfying the performance obligation. And also the time value of money is significant. What does it mean? Time value of money is significant, you are receiving before or after. See, either you are receiving the payment way before you are finishing your performance obligation, or you are receiving money way after you have finished your performance obligation. So the time lag uh, what can I say? There is a long time gap between you receiving the money and you performing the performance obligation. Either you are receiving money first from customer, you are satisfying the performance obligation later, much later. So that late, because it's much later, time value of money is significant. Or you are satisfying the performance obligation. You have built up contract, you have given the service to the customer, but you are not receiving the payment from customer. It's taking a long time to get that payment back from the customer. Then also time value of money is significant. So that is known as significant financing component, that price that you are receiving. Okay. So in your contract price, that significant financing component that you might receive way earlier or way later is included. Okay. Now, in this case, you have to adjust the contract price. So the contract price must be adjusted for interest when you're determining the transaction price, where a payment is received before satisfying the performance obligation. That means before you have done your job, before you are giving the good and service, you have received the payment. It's a prepayment. It's a payment in advance you have received. What happens? Cash consideration is less than the transaction price and an interest expense will be recognized by the seller. This we'll see in example 3. Okay. Now, the other way around. You have received the payment after satisfying performance obligation. Then cash consideration is more than the transaction price and interest income is recognized. This will see in activity 1. So you have to remember these two things. Okay. If you are receiving before, what is the treatment? If you are receiving the payment after, what is the treatment? If it's before, interest expense. If it's after, interest income. So we'll see both example 3 and activity 1. And in both cases, that interest element will be recognized in the operating category in your statement of profit and loss. This is where the change took place in your IFRS 15 because of IFRS 18 that has been introduced. You can go back to my IFRS 18 and check what is this operating category that I'm talking about. If you haven't watched my IFRS 18 lecture, by the way, and if you want to get the link of my all the previous lectures for financial reporting, you can click the I button given on the screen on your right hand side, and also the link is given at the end of the video. Now, as a practical expedient, a financing component is not deemed to be significant if the period between the transfer of good and service to a customer and when the customer is expected to pay for them is 1 year or less. If you are paying 1 year within 1 year or less, or you are paying within 1 year or less before and after the transfer of good and service, but the time period is not so much, not more than 1 year, then what happens? Your financing component is not significant in this case. So an interest element will not be separated from the transaction price. Remember this. Interest element will only be separated from the transaction price when there's a significant financing component. See, take it like this. It's like a loan. Okay? It's like a liability. When there's a significant financing component, you are taking a finance. Why? On a loan, there is an interest. Isn't it? That's why we are separating that interest from transaction price when time period is more than 1 year. Significant financing. But if it's not significant, no interest element. Okay? Now, example 3. This is when with the payment in advance. Significant financing with the payment in advance. That means significant means more than 1 year. So there will be an interest element. Always, whenever significant financing component is there, do not forget the interest element. But you have to know whether it is an income or an asset. That means interest income or interest expense. So let us see this. On 1st July 2007, FLS entered into a contract with the customer to build and deliver a new bespoke machine on 30th June 2008. That is 1 year. Contracted price was 840,000. Customer paid on 30th June 2007 and appropriate interest rate is 8%. Financing component is considered to be significant. See, in your exam, they will always tell you financing component is significant or not. Mostly they will give you significant only because they want to test this area. Okay. And this is also a very common area by the way, frequently asked in exam. So be prepared for this. They should recognize the receipt of the cash payment. See, they are receiving cash now. So of course, debit bank or cash, and credit deferred income, or you can say contract liability. See, you are receiving in advance. You are receiving in advance, you have to pay back. Still, it's a liability for you. You can't recognize it as an asset, as a revenue, because you have not finished your performance obligation. You have an obligation to finish your contract. That's why contract liability. There's an obligation for you to satisfy your performance obligation, which you haven't, but you have received the payment. So that's why debit bank and credit contract liability or deferred income, 840,000. Next, customer has provided the financing to FLS. Customer has provided this financing. That means they have paid to the company in a substance a loan. Okay, this so in substance, that's what I told. Take it as a loan. Okay, in substance, it's a loan only. That customer is giving a loan only to this one. That means they have to pay back. Equity has to pay back to the customer the amount with the interest. So over the period to this one. Now they have to recognize an interest expense. See, who is taking a loan? Please understand. Customer is giving a loan to the FLS. FLS is taking a loan. If he is taking a loan means on that he has to pay an interest also. So he has two things. One contract liability, other one interest expense. So take 8% of 840, that is the interest. You see, so debit interest expense, credit contract liability. Next, now they have satisfied the performance obligation. So now what happens? Your contract liability cancel off. How do you cancel? By debiting. Now you can recognize the revenue. So debit liability, contract liability, credit revenue. How much? Remember, with the amount of your liability, 840,000. This is your contract liability, 840. You have to add the interest also, 67,200. So once you add it, it is 907,200. This is your revenue. You recognize. This is always the case for payment in advance. You recognize the revenue at the end and just reverse, just debit your contract liability. Okay. Now, so this is about payment in advance. What if you are paying late? Well, this will see in activity 1. Just reverse it. Here, on 1st June 2005, SDF is selling furniture to a customer for 4,000 with a 3 years interest-free credit. Customer took the delivery of the furniture and the 4,000 is payable on 31st December 2007. Now they are paying late. Customer, you have sold the furniture 1st Jan 2005. But see, when are you receiving the payment? 31st December 2007, almost after 2 years. Not even 2 years, 3 years. An appropriate discount rate of 8% is given. So now you will recognize an interest income. Why? Take it like this. Now you are giving, see, because you are receiving late. So you have to receive it. Now it's a loan. It's like you have given a loan to the customer and customer has to pay you that amount. That's why now you will recognize interest income. And it's an asset for you, contract asset. You understand? Just reverse it. If you're not understanding both the side, understand one side. For advance in payment, it's an interest. You have taken a loan. There is a loan taken for entity. Entity has to pay back with interest. So if you are paying it arrears, you have been paying late, just reverse it. It's interest income and it's not a contract liability. Now it's a contract asset. It's easy. Contract asset debit, interest income credit. So now the transaction price will be, remember you have been given the discount rate. You have to find the present value. It's 8% and for 3 years. So this is how you find the present value. The amount of your loan, that is 4,000, divide by 1.08 because 8% discount to the power 3 because for 3 years. And this is your price. So your transaction price has to be 3,175. Okay. Because the financing component you have to consider when you're determining your transaction price today. You have to see this element that they'll be being late. That's why your transaction price is this now. So interest income will be like this. This is called unwinding the interest. 8% on this 3,175. So for 2005, just 8% on 3,175, 254. Next year, you will keep on adding the interest and then take 8%. You understand? It's like a compound interest. So 2006, with this transaction price, you will add the previous year's interest, that is 254, and then take 8%. And third year, that is 2007, you will add with their transaction price 3,175, 2005's interest, that is 254, then 2006 interest, that is 274, and then take 8%. Hence 297. Okay. Now, non-cash consideration. A customer may provide consideration in the form of an asset other than cash. So in this case, you have to measure the consideration at fair value. If you cannot estimate, then the consideration will be the stand-alone selling price of the good or service that is provided to the customer. Next is variable consideration. Okay. So consideration may be variable for a number of reasons. Maybe you might be having some discounts, some rebates, some performance bonus and penalties. But these are contingent upon a future event. For example, a performance bonus will be awarded if you are meeting a certain target within a set time scale. Next, a penalty may be charged if a contract to deliver service overruns. That means you are taking more time than when you are supposed to deliver the contract. Then there will be a penalty that will be charged. Then, so the variable elements of the considerations are only included in the transaction price if it is highly probable that a reversal in the amount of revenue recognized will not occur when the uncertainty is resolved. In other words, variable consideration is included in the transaction price if it is highly probable to arise. What does it mean? That means because later, see, because of uncertainty now, okay, once the uncertainty is resolved, the revenue that you have recognized will not be reversed. If there's high probability of that happening, then the variable element you will add with your consideration. You understand? So high probability means variable consideration will be included in the transaction price. Now, example 4. This is an example of a variable consideration. So let us go through example 4. Now, a construction company enters into a contract to build a new health center. The contract requires completion of the center within 6 months. Contract price is 9.8, but this will be increased by 500,000 performance bonus if construction is completed within 5 months. So now you have to see whether we will include that 500 in that 9.8 or not. Okay, it's a variable consideration. So see, let's check the answer. The construction company, they should consider various factors when they're deciding whether it is likely to be paid the performance bonus or not. What are those factors? 1. Can they meet the contract within the reduced time scale? This they have to see whether they have the available material, whether they have the available labor so that they can work faster and finish the work within 5 months rather than 6 months, the standard, that is the time, actual time. Also, because it's a construction, you have to check the weather of the weather condition, very important. It will have an impact on the construction industry. Okay, and also other factors outside the company's control. The next, company's experience of a similar contract. Did in the past, were they able to finish in the less time? So it will depend on this 3 factor. But this assessment is subjective. Okay, so if the company decides that it is not highly probable that construction will be completed in 5 months, then transaction price will remain 9.8 only. Okay, and if it decides that it is highly probable that they can finish within 5 months, then the transaction price will be 10.3. That means with this 9.8 they will include 500, hence 10.3. 9.8 plus 0.5. Okay, this is million and this is 0.5 million. Now, assuming we have satisfied the performance obligation over time, this we have said section 1.6 will cover. The construction company will recognize the revenue gradually as the health center is constructed. So the objective of IFRS 15 in considering variable consideration is that recognized amount will not be adjusted subsequently. Once you have recognized, it will not change, especially for variable consideration. Now, allocating the transaction price is the next. So the transaction price is allocated to all the separate performance obligation. If there are 4 performance obligation, your transaction price, see, your transaction price is given in the beginning of the contract. It's only one price. That price will be allocated among the 4 performance obligations. Okay, in proportion to the standalone selling price of the goods and services. Proportion is the selling price. What is the meaning of standalone selling price? The price at which an entity would sell a promised good or service to a customer. So the best evidence of the standalone selling price is the observable price of a good and service when it is sold separately. This may be contractually stated price or a list price, but it is not presumed to be. Okay. Allocation is made at the beginning of the contract, not adjusted for any subsequent change in the standalone selling price. Okay, beginning. If not observable, then there are some suitable methods for estimating the standalone selling price. Okay, maybe an adjusted market price, a competitor's price, or an expected cost plus margin. Now, activity 2. So here we have to allocate transaction price. This is about again Jackson entering into, so that's the same example, entering into a contract for the software license, installation, update and technical support for 5 years in exchange for 240,000. You have been given only one price. Now, they have determined that these four are separate performance obligation. So there are four. Software license installation, they have given you the standalone selling price of all these four. So now you have to allocate this 240,000 among these four performance obligation based on their price. So now let us do. It's very easy. You just have to know maths. See, the transaction price is 240. It remains for each. You only have to allocate the selling price over the total. So the software license price is 150. Total price was 300. This is 60 over 300. This is 40 over 300. And technical is 50 over 300. So when you add together, total has to be 240. So out of this 240, 120 is for software, 48 installation, 32 software, and 40 technical. So that's why you need the selling price of each of these four performance obligation to get the allocation of the transaction price, because otherwise you will not know the proportion. Now, finally, the final stage is recognizing revenue. You have to recognize revenue when a performance obligation is satisfied by transferring the good or service to a customer. An asset is transferred when the customer gains the control of the asset. Performance obligation can be satisfied over a period of time or at a point in time. You have to see. Now, example 3, transaction price over a contract. So this is about a free phone, okay, offering a free phone with every pay monthly 2-year contract for telecom service. Contract is 30 a month and standalone selling price of the phone is 250. Now, the standalone selling price for similar telecom service is 24 a month. That means 576 over 2 years. 24 into 24. Now we have to get the total transaction price. How? See, 2 years means 24 months. And standalone selling price is 30. Okay. So there are two things. One is telecom service, one is phone. Okay. So if you see, this is $30. Okay. The 30 into 24 because 2 years. So 30 into 24. Total transaction price is 720 for the phone. Okay, sorry, this total transaction price. This you have to allocate between two performance obligation. One is phone, one is telecom service. So if you want to know the total, the standalone selling price of similar telecom, 576, and for the phone it is 250. So 250 and 576, and 250 over the total, because this is for phone, so 250 over the total, and 720 since is the total transaction price you get for the phone. And then next you do for the telecom service similarly, that is 576 over total into 720, and total you have to get 720. This 720 is allocated among phone and telecom service. Now you have to be very careful. This two performance obligation, one is phone, one is telecom service. Phone is easy. You give the phone to customer, customer takes the control of the phone, you recognize revenue. What about telecom service? Over 2 years you have to recognize the revenue. So phone is at a point in time, telecom service over a period of time you are recognizing revenue. So that's the answer. Revenue of the phone is recognized immediately when customer takes the control of it. Revenue for the telecom will be recognized over 2 years. Now, next, performance obligation satisfied over time and at a point in time. So when you're satisfying the performance over a period of time, this is usually common for services. Services are satisfied over a period of time. You will recognize revenue also over time. Okay. Performance obligation is satisfied over time if one of the criteria is met. First criteria, where customer is receiving the benefit and consuming the benefit simultaneously. One example is right now what I'm doing here. I am recording the video and you are actually receiving the benefit. So it is simultaneously happening. I'm not keeping it, storing it, and then giving you the product. No. Same time I'm performing, I am talking, I'm teaching, you're receiving the benefit. Simultaneously, this is happening. So it's over a period of time. Okay. For example, cleaning service or a monthly payroll processing service or teaching. These are over a period of time. Next, performance creates or enhance an asset that customer controls during the creation or enhancement. So while you are performing, while you are creating, customer is okay. Performance will create an entity and creates or enhance an asset that customer will control during that creation. Customer will control it. For example, when you're building, when you're constructing a building, okay, so you are creating it, you are making one floor, two floor, three floor, you're adding like that. Who is controlling it? Customer. The moment you are creating, customer controls it during that time, because at the end control will go to the customer. Next, your performance does not create an asset with an alternative use for the supplier. It is for whom you are creating, only that person can use it. It's not customized. You can't use it for an alternative purpose. For example, if you are constructing a school, you can't use it for another purpose. Okay. So therefore, whatever you have done, you have an enforceable right to payment for the performance completed to date. Whatever you have completed, even if not full, at least you will get the partial payment. So this, any of these three is made, it is overtime. Next, at a point. This is easier. But in your exam, check whether it is at a point in time or over a period of time. Mostly, they might give both, but mostly what I've seen is over a period of time. That's what they usually get in the exam. Okay, so when a performance obligation is satisfied at a point in time, revenue is also recognized at a point in time. Revenue should be recognized at the point when customer is having the control of that asset. And how do you know transfer of control has taken place? These five are the indicators you have to see in your case study in your exam. First, customer has an obligation to pay for an asset. Customer has the legal title to the asset. Entity has transferred the physical possession of the asset. Customer is bearing the risk and rewards of ownership, and customer has accepted the asset. Now, example 4, satisfying of performance obligation. Again, it's a Tanner. Same example, is building a multi-unit residential complex. So customer agrees to make the progress payment during construction. Customer fails to make the progress payment. Tenant has the right to the consideration for entire contract if it completes the unit. Terms of the contract prevents the entity from directing the unit to another customer. So if you see, they have met the condition. This is satisfied over time. Why? No alternative future. This is the third point, the third criteria. No alternative future. Okay. Next, tenant has the right to payment for performance. So these are the two things. Okay. The first point where they are simultaneously receiving and consuming, that point doesn't appear here, but the other 2 points appears, and they told one of the criteria has to be met, and it has met 2 criteria. Next, example 5. In this case, it's about again Tanner and enters into a contract with the customer for a specific unit that is under construction. So these are the terms. Customer will pay a deposit when they are entering the contract, and it is refundable if entity fails to complete the contract. The remainder of the purchase price is due upon the completion of the unit. If customer defaults on the contract before completion, tenor only has the right to retain the deposit. That means tenor can only have the right to retain the deposit, not the entire unit. So this performance is satisfied at a point. Why? A, not a service contract. B, customer will not control the unit as it is created. And entity does not have an enforceable right to payment for performance that is completed to date. They can only take the deposit, but they can't say that they are going to have the right to payment for the performance that is completed to date. Example, entity only has right to deposit until the unit is complete. So that's why it is satisfied at a point in time. Now, measuring progress towards completion. A revenue that is recognized over time. This is for over time, not at a point in time. Over time, it is based on the progress towards completion. You have to know what is your progress towards completion. Are you completing 60%, 30%, 40%? Based on that, you can recognize revenue. But it is the progress method is measured using two methods, output method or input method, and it can only be recognized if progress can be reasonably estimated or no reasonable estimate of progress. But if there is no reasonable estimate of progress but costs are expected to be recovered to the extent of the cost incurred, you can recover the cost. Then you have to recognize. First, let's go through the output method. Output method recognizes the revenue based on the value to the customer of the good and service that is transferred to date relative to the remaining good that has been promised. Examples of output method: service or performance completed, that is work certified to date; appraisal of the results achieved; milestones achieved; time elapsed; units produced or delivered. These are all based on output methods. You look at the output and decide how much you have completed. Next, output method should only be used when the output selected represents your performance towards complete satisfaction of the performance obligation. One disadvantage is output may not be available or directly observable. So in this case, you can use input method. Input method, also known as cost method, you look at the input. That is based on your effort or input to satisfy the performance obligation relative to the total expected input. Examples are, you see how many labor hours worked, cost incurred, time elapsed, and resources consumed. Revenue can be recognized on a straight line basis if inputs are used evenly throughout the performance period. Now, example of a straight line basis. So this is about a health club entering into a contract for 1 year of unlimited health club access for $75 per month. Health club determines that customer is simultaneously receiving and consuming benefit of the club's performance. So the contract is a performance obligation over time. Because the customer benefits from the club service evenly, best measure would be, so the progress towards complete satisfaction of the performance obligation is time based. So revenue will be recognized on a straight line basis throughout the year at 75 per month. Okay. Now, activity 3. So in activity 3, you have to use both the method and recognize revenue. You have to calculate revenue to be included in your statement of profit and loss using work certified, that is output method, or basis of cost, that is input method. You have been given, it is the same question. 10 is building a multi-unit residential complex, giving a specific unit to a customer, and this is single performance obligation satisfied over time. Now, cost incurred to date, future expected cost, work certified to date, expected sales value, revenue recognized in earlier period has been given. So now based on this, let us first find out output method. So here on your left hand side, this is the work certified basis, and here it is the cost incurred basis. First, find the percentage. This percentage is very important. Without this percentage, you can't find the revenue under both the methods. So the proportion. So it is work certified to date. So what is the work certified to date? It is 1,800. What is the expected sales value? 3,200. So 1,800 by 3,200. That is 56.25%. This is the work certified basis. And this 56.25% you use here in your revenue. This 3,200 is your sales. Okay. So now coming to the cost. Cost. See, cost is 1,500 and future expected cost is 1,000. So total cost is 2,500, out of which your cost incurred to date is 1,500. So 1,500 over 2,500 is 60%. And this 60% you are using here. So now it is work certified to date 1,800, and you take expected sales value, that is 3,200, and you take this because you can't recognize the full revenue. So work certified, and you deduct this. The current year is this revenue you have to recognize. And then according to the cost, okay, this is your revenue 3,200 cumulative, and your prior year. So prior year cost is 1,200. So revenue recognized in earlier periods is 1,200. Okay. So here also you take 1,200 prior year revenue, and here also 1,200 prior year revenue. This is percentage you multiply into the sales value, and here also, and you get the sales. So the current year it is 720. Okay. So the revenue recognized at the end of the first year is assumed to be the same using both methods for simplicity. In practice, it is unlikely to be the case. For simplicity, we'll assume under both methods revenue at the end of the first year will be same. Now, so now we are moving on to the contract cost. Recognizing contract cost. How do you do that? The types of contract cost. Although IFRS 15 focuses on recognition of revenue from contract with customer, it also deals with the cost. An entity can incur two types of cost regarding contracts with customer. First, cost to obtain a contract. Next, cost to fulfill a contract. IFRS 15 provides guidance on the accounting treatment that should be applied for both this type of cost. Okay. First, incremental cost of obtaining a contract. The cost that you would have obtained for the contract that you would have not incurred if the contract has not been obtained. That means you are only incurring this cost because of that contract. Otherwise, it could be avoided. It is known as incremental cost. So incremental cost of obtaining a contract like sales commission, they are recognized as an asset if the entity expects to recover them. Okay, remember, if the entity expects to recover them, they are recognized as an asset, the contract cost. Because they are an asset, they must be depreciated or amortized. They are intangible. That's why you amortize them. So they are then amortized over the goods or services that are subject of the contract. Okay, that are the subject of the contract are transferred to the customer. So over the goods and services that are transferred to the customer, you will keep amortizing. Next, cost that would have been incurred whether you obtain the contract or not are recognized as an expense in the operating category in your statement of profit and loss. Okay. Now, example 9. This is about incremental cost. So once again, it's about Jackson. It's about the four things: license, installation, software updates, and technical support for 3 years in exchange for 240. These are the costs. You have to determine which cost they should recognize as an asset and which should be expense. First is legal fees for drawing up the contract, travel cost to deliver the proposal, and then the commission to sales employee. So first, legal fee. Legal fee and sales commission, they should be recognized as an asset because they are the cost of obtaining the contract. So assuming the developer expects to recover them. What about the travel cost? This, it is expense because they would have incurred even if the developer did not get the contract. You understand? Now, cost to fulfill a contract. Any cost of fulfilling a contract that are within the scope of another standard, let's say IS2 inventory, or IS16 property, plant and equipment, or IS38 intangible asset, you should account based on those standards, not IFRS 15, if it falls within the scope of another standard. Okay. The direct cost to fulfill a contract that are not within the scope of another standard, you will recognize as an asset under IFRS 15. Only if they are meeting a specified criteria. All other direct costs are recognized as an expense in the operating category of a statement of profit and loss. Now, exam advice. The criteria to recognize cost as an asset will not be asked in your financial reporting exam, thank God. Okay. Now, cost that relates directly to a contract includes any of the following. Direct labor, employees who provide the promised services. Next, direct materials, supplies that are used in providing the promised services. Allocation of costs that relate directly to the contract, for example, contract management, insurance, depreciation of equipment. Costs that are explicitly chargeable to the customer under the contract, and other costs incurred due to entering into the contract, for example, payment to subcontractors. These are direct costs. Now, other costs related to the contract are always recognized in profit and loss, which includes general and admin cost, cost of wasted material, labor, other resources that were not reflected in your price of the contract. Now, exam advice. In your financial reporting exam, any cost incurred to fulfill a contract with the customer should be recognized as an operating expense as they are incurred. Remember this. Now, activity 4. Again, Jackson, who is having the 4 performance obligation about license, installation, update, and technical for 3 years. So to fulfill the technical support, these are the cost. Okay, you have to explain the cost that are incurred in fulfilling the technical support. They have purchased an additional workstation for the exclusive use of the technical support team for 9,000. They have assigned one employee to be primarily responsible for providing technical support to the customer. This employee also provides services for other customers. The employee is paid an annual salary of 60,000 and expected to spend 20% of his time supporting his customer. Tell me, what about the workstation? See, the additional workstation, initially it will be recognized as an asset under IS 16. So you have to depreciate it. Okay. So the depreciation of this equipment will be included in the cost that relates directly to the contract. Assuming it's a 3 years life, they have told it's for 3 years because the contract to give service to the customer is for 3 years. So useful life will be 3 years and no residual value. So you divide it by 3. 9,000 will be divided by 3, depreciation 3,000. What about the employee? You only can take 20% of 60,000. That is 12,000. So a proportion of the cost of the employees that are assigned to providing technical support you have to include as an asset. In this case, it is only 12,000 for each of the 3 years. Because your contract to provide the performance obligation, technical support is for 3 years. That's why. Now, loss-making contract. A contract is loss-making if the expected cost to fulfill the contract is more than the transaction price. It is described as an onerous contract. You should always check whether the contract is a loss-making or a profitable before you apply IFRS 15. And if a revenue from a loss-making contract is recognized at a single point in time, related costs are also recognized at this time, and any loss will be recognized in full. If revenue from a loss-making contract is recognized over time, it is likely that the application of IFRS 15 in the first year of the contract means full loss can't be recognized. So in this case, you have to recognize a provision for the remainder of the expected loss, and provision are dealt under IS 7. Okay. Recognition of a provision for an onerous contract will deal under lecture 15 for IS 37. Example 10. So Avi is entering into a contract with a customer during 2005. Contract price is 5. Because of the shortage, cost expected to rise to 5.3. You see, there's a difference. Price is 5, contract cost is 5.3. They have applied IFRS 15 and concluded revenue is 2.9. And the cost was 3. So you have to explain how they have to recognize the contract in the financial statement. So see, revenue and the cost both will go in the operating category. For this, that's why I always told you before you come to any standard, first go through IFRS 18. Because otherwise you will not understand what is this operating category of statement of profit and loss. Because your IS1 that you have previously gone through is now replaced by IFRS 18. It's changed and the terms are changed. So both your revenue and cost will be recognized in that operating category. First category under statement of profit and loss according to IFRS 18. So revenue would be 2.9, cost is 3. You see there's a loss, so revenue is less. So that loss of 0.1 is recognized in the year. Whatever the total expected loss, your contract price is 5, cost is 3, total is 0.3. So current loss is 0.1, total expected loss is 0.3. The difference 0.2 is a provision. Okay. So a provision for 0.2 in the statement of financial position you have to recognize. Now, part 4. How you will record in your statement of financial position. In a contract with a customer, an entity recognizes revenue to reflect its own performance in delivering goods or services. That means the party who is delivering the good and service will recognize revenue, and a receipt of cash or a receivable, if you're not paying in cash, will reflect the customer's performance in paying or promising to pay for goods and services. Remember, in a contract there are two parties. Entity who delivers goods and services, they will recognize revenue. The other one party, that is the customer, who will give you the cash, or if they are buying in credit, they will pay later, hence receivable. Okay. So when the amount of the revenue recognized is equal to the cash receipt, there is no impact on the statement of financial position. Okay. So the revenue recognized is equal to the cash receipt, or revenue recognized is equal to the amount that is due from the customer. If both are equal, no impact on the statement of financial position. But when the performance by the two parties, that means the revenue is not equal to the cash or the receivable, then an asset or a liability is created and it is recognized in your statement of financial position. So although applying IFRS 15 guidance on amounts that is recognized in the statement of financial position may not be straightforward in practice, in your financial reporting exam it is simplified. Approach required in financial reporting is explained in the next section. Let's see section 4.2. The balances in the statement of financial position. So a selling entity may recognize a trade receivable when the amount invoiced is more than the amount that is received from that customer. That means amount you are receiving from the customer is less, you have more to receive later on, because actual amount invoiced is more. Then trade receivable will be recognized. Next, a contract asset. When your revenue is more than the amount that is invoiced to the customer, it's a contract asset. Or a contract liability, when amount invoiced is less than the revenue recognized. Sorry, when the amount invoiced exceeds your revenue recognized. The other way down, just change. In contract asset, revenue is more than the amount invoiced. Contract liability, amount invoiced is more than the revenue recognized. It's a contract liability. Okay. Now, selling entity. So they will do the calculation of a contract asset or a contract liability. For them, this is very easy. Okay. Calculation of contract asset or liability is very straightforward. Just take the revenue, deduct the amount invoiced to date, and get a contract asset or liability. If after you deduct your amount invoiced from revenue, if you are getting a positive figure, it's a contract asset. That means revenue is more. And if it's a negative figure, it's a liability. That means revenue is less. So the term contract asset and liability can also be referred as accrued income and deferred income. Okay, retrospectively. Now, IFRS 15 is requiring you to show the contract asset, contract liability, and trade receivable separately. You cannot offset contract asset with contract liability, even if that contract is with the same customer. Okay. So no offsetting of contract asset or contract liability for different contracts, even with the same customer. And otherwise also it's not allowed. Now, this is an exhibit. This is an example of how your contract asset will appear in the statement of financial position. Okay, so you see your contract asset is in red after the lease receivable. It's under non-current asset, contract asset. Okay, and then if it's a contract liability, it is recognized here under your non-current liabilities. Now there is a note. If your contract has 12 months or less remaining, then your contract asset and contract liability will be presented as current rather than non-current. Now, example 11. So, on 1st Jan, they have entered into a non-cancelable contract with tenor to sell an excavator for 350,000. They have delivered this on 1st April. Contract requires to pay 350 in advance on 1st Feb and tenor makes a payment on 1st March. Now you have to show the journal entries. Remember, in your financial reporting, you have to know the journal entries, very important. It's not always asked, but wherever it is asked, it is very easy marks. And many students struggle for the journal entries. Trust me, even if it's easiest, many students forget that these are the basics. These are your basic accounting that you have studied in your financial accounting. So on 1st Feb, they are recognizing a receivable because it has an unconditional right. Okay, should the consideration. So the contract is non-cancelable. Because the contract is non-cancelable, and if the customers are delaying in paying, you have to recognize a receivable. Okay, remember the date. There are 3 dates: on 1st Feb, on 1st March, and on 1st April. On 1st Feb, customer has not paid, so you will recognize a receivable of 350 and it's a liability. Credit side is on the liability, 350,000. Okay, 350,000 on pass. Coming to 1st March. Now, what happens in 1st March? They are making a payment on 1st March. So debiting cash 350 and receivable is credit 350. Now that receivable will be cancelled that you have recognized on 1st Feb. Earlier it was a debit balance. Now because cash is paid, receivable account will be cancelled by crediting 350,000. What about 1st April? 1st April, you have to recognize a revenue when you have delivered the good to tenor. So you will recognize the revenue 350 and the contract liability that you have credited 350 here in 1st Feb. Now you debit it. You have to close down that contract liability by recognizing revenue. And you see always your debit and credit has to be equal. Now coming to example 12. You have to prepare journal entries to show how Edison would account for this contract. So here they have entered into a cancelable contract once again to sell 350,000 each. The contract requires 1 to be delivered on 1st Feb. It states that the payment for the delivery of the first is conditional on the delivery of the second and will only be invoiced when the second is delivered. So the second was delivered on 1st June. There are 2 dates now, 1st Feb, 1st June. So on 1st Feb, now they will recognize a contract asset and revenue when it satisfies the performance obligation. So contract asset is debit, revenue is credit 350,000 when they have delivered 1. Now, a receivable is not recognized on 1st Feb because Edison has not been invoiced. That's why you can't recognize revenue. And what about 1st June? They will recognize a receivable and revenue when it satisfies the performance obligation to deliver the second. So 350 and 350. Receivable is debit now. The two, one for 350, so 2 will be for 700. And credit revenue 350 and credit contract asset 350 that you have been debited. Okay. Now, activity 5. So activity 5, the contract is expected to take 3 years to complete. This is from your activity 3 by the way. And customer has contracted to pay 1,000 at the end of the first 2 years and balance on completion. The customer paid the first 2 installments when they fall due. Okay. So end of the first year, what was the revenue? You have to take from your activity 3. Okay. The revenue that was recognized to date. So 1,200. From there, amount invoiced is 1,000. So deduct. Because it's a positive figure, it's a contract asset of 200. Coming to the second year, revenue recognized to date was 1,800. This is from your activity 3 you have to take. And then Amount invoiced is 2000 now. Okay. See, the contract is expected to take 3 years to complete, and the customer has contract to pay 1000 at the end of each of the first 2 years. So 1000 first year, second 1000, it will be 2000. Okay. So here it's a contract liability because negative figure. Now, specific transaction. So now let us move from contract to specific type of transaction. There are 4 specific transactions. First one, principal versus agent. When an entity uses another party to deliver their goods and service to the customer, okay, you have to determine whether they are acting as a principal or an agent. Very important. If you are a principal, entity will control the good and service before transferring to the customer, and revenue will be equals to your gross consideration. And if you are an agent, entity arranges for the other party to provide good and service, and your revenue will be the fee that you receive or a commission. The fee or commission may be the net consideration that the entity retains after paying the other party the consideration received in exchange for good. Now, indicators that an entity is a principal and controls the good and service before delivered to customer. Entity will be responsible for fulfilling the contract, that means meeting customer specification. Entity has inventory risk before and after good and services is transferred to customer. What are the risks? Risk that goods might be returned by the customer. Risk that the goods might be out of fashion. Entity has discretion in establishing prices for the goods and service. So these are the 3 things you have to look for. If these 3 things are present, it is entity is a principal. Now, example 3. Determine whether Anderson is acting as a principal or an agent. So, on 1st Jan, they have entered into a contract with Tanner to sell excavator with a unique specification. They both have developed the specification, and Anderson contracts with a construction equipment manufacturer. Manufacturer will deliver the equipment. Addison agrees to pay the manufacturer $350 upon delivery, and Tanner agrees to a selling price of $385. Addison's contract with Tanner requires Tanner to seek remedies for defects for the manufacturer, but Addison is responsible for any corrections due to Addison's specification. See those 3 factors. Who is having the inventory risk? Whether Addison is having discretion. Whether Addison is responsible for fulfilling the contract. So let's see these 3. So in this case, yes, Addison is acting as a principal. Why? Based on the first one. He is responsible for fulfilling the contract. Why? Because he is responsible for any corrections due to errors in the specification. Point number 1. Point number 2. Anderson has inventory risk because he is responsible for correcting the errors, even though the manufacturer has that inventory risk during production. Next, Addison is having a discretion, that means he is controlling the prices. He is setting the selling prices. So in this case, yes, Addison is a principal. Now, repurchase agreement, the second specific transaction. For repurchase agreement, a contract in which an entity sells an asset and also promises or has an option to repurchase the asset. So they sell the asset, they have an option that they can repurchase the asset. When an entity has that option to repurchase the asset sold, the customer will not obtain the control of the asset, and entity will account for that contract as either of these 2, either lease or financing arrangement. Okay, lease if it can or must repurchase the asset for less than the original selling price. That means you should be able to repurchase the asset at less than the original selling price. Then only it's a lease. Or a financing arrangement if it can or must repurchase the asset for an amount equal to or greater than the original selling price. Remember this. If you are repurchasing the price at less than the original selling price, is a lease. If it's more or equal, financing arrangement. Now, if it's if a repurchase agreement is a financing arrangement, entity continues to recognize the asset. Okay, financing arrangements means you are repurchasing at an amount greater or equal to the original selling price. So in this case, you will recognize the asset, you will recognize a financial liability for any consideration received from the customer, and recognize the difference between the amount of consideration received and to be paid as an interest expense, which increases your financial liability. Okay, with financial liability comes interest expense. Now, in your financial reporting, you will not be required to account for a sale and a repurchase agreement that is a lease. Thank God. So you only have to work on this part, the financing arrangement part. Okay. Now, example 11 is an example of a repurchase agreement. Let's see. So on 1st Jan, they have entered into a contract to sell an excavator for 350. Under the term, they have an option to repurchase for 385. On or before 31st December, they have paid 350 on 1st Jan. On 31st December, their option lapses unexercised. Explain how they will account for the transaction on 1st Jan, during the year, and on 31st December. 3 dates are there. So, here's the solution. On 1st Jan, they will recognize a financial liability. It's a financing component, remember. Because original selling price was 350. You are repurchasing it at 385. So, financial liability. So, you debit cash and you credit liability. During the year, they have to account interest expense of 35,000. That is 10% of this. By the way, this till 10. So it's the difference between 385 and 3. So that's 35,000, the difference. So the difference between repurchase 385 and cash receipt 350. So debit expense and credit financial liability. Next, on 31st December, when option lapses, they will de-recognize the liability and record a sale. So debit financial liability 385, credit revenue 385. Now, next, specific transactions, bill and hold arrangements. Bill and hold, a contract in which the entity bills a customer for a product not yet delivered to customer. So you cannot recognize a revenue for a bill and hold arrangement until customer obtains the control of the product. Generally, control is transferred to the customer when the product is shipped or delivered to customer, depending on the terms of contract. However, in some contract, customer obtains the control of the product without taking physical possession. They might not physically take the possession, but still they are controlling the product. For a customer to have obtained the control of a product under a bill and a hold arrangement, all of the following criteria must be met. First criteria, substantive reason for bill and hold arrangement. Example, customer has requested because it does not have space for the product. Next, product has been separately identified as belonging to the customer. Product is currently ready for transfer to the customer. Entity cannot use the product or direct it to another customer. So if these 4 conditions are there, all 4 are there, customer, it is said that customer is having the control of the product. Hence, you can recognize revenue. Now, example 15 is an example of bill and hold arrangement, where you are supposed to identify the performance obligation and determine when the revenue should be recognized on each performance obligation. So here, Edison is entering into a contract to sell an excavator and spare parts, 2 performance obligation. One for spare parts, the other one is for excavator. So the manufacturing lead time is 6 months. On 1st July, they are paying for the machine and spare parts, but only taking possession of the machine. Tana inspects and accepts the spare parts, but asks that they are stored in their warehouse because Tana is short on storage space. Edison expects to store the spare parts in a separate section for 3 years. Parts are available for immediate delivery, and Edison cannot use the spare parts to another customer. So now, 3, to provide the excavator, to provide spare parts, custodial services related to spare parts. These are the 3 performance obligations. Now, Tanner is obtaining the control of the spare part on 1st July because all of the criteria are met on that date. There is a reason why Edison is telling them to hold the spare parts. The parts are separately identified and ready to transfer, and Edison cannot use the part for other customer. That's why. Next, Edison will recognize revenue for the excavator and spare parts on 1st July. And they will recognize revenue on custodial services over the 3 years the service is provided. Okay, for excavator and the spare parts on 1st July only, they will recognize when it is transferred. Now, last transaction is consignment. When an entity delivers its product to a dealer or a distributor for sale to an end customer, they have to determine whether the contract is a sale or a consignment. If it's a sale, dealer has obtained the control of the product. So they will recognize revenue when the product is shipped or delivered to dealer or distributor. If it's a consignment, dealer will not have obtained the control of the product. They will recognize revenue when the dealer sells the product to a customer or when the dealer obtains the control of the product after a specified period of time expires. Be very careful whether it's a sale and consignment. So these are the indicators of a consignment arrangement. First, entity controls the product until a specified event occurs, such as the sale of the product to a customer or until a specified period expires. Next, entity can require the return of the product or transfer the product to another party. Dealer does not have any unconditional obligation to pay the entity for the product, although it might be required to pay a deposit. Okay. Now, example 16. Car dealership arrangement. So, FMC, a large multinational car, they deliver car to a car dealer. Legal title passes on the sale of public. Car dealer must pay for the car when the legal title passes. Price to the car dealer is determined on the date they deliver the FMC delivers the car to the dealership. They can require the return of the car and if not sold by the car dealer can transfer the car to another dealer. You have to determine whether the delivery of the car is a sale or a consignment. So in this case, it's a consignment. Okay. Why? Because dealer did not obtain the control of the car. How can you say? It is evidenced by the fact that AMC can require the return or transfer the car and the dealer will not have any unconditional obligation to pay FMC for the car. So you should not recognize the revenue until the dealer sells a car. Dealer has to sell this car to the customer. It's a consignment. Now, that's it. So we have covered section B, revenue. We have explained and applied the principles of revenue recognition. That are the 5 steps: identification of contract, performance obligation, determining transaction price, allocating the price to performance obligation, and recognizing revenue over a period of time or at a point in time. Next, we have explained and applied the criteria for recognizing revenue over a period of time or at a point in time. Then we have described the 2 methods to measure progress towards completion, inward and outward method. Then we have explained and applied the criteria for recognizing contract cost. So for applying the principles of recognition of revenue specifically for the following type of transactions: principal versus agent, repurchase agreement, bill and hold, and consignment arrangements. And then we have prepared financial statement extracts for contracts when performance obligations are satisfied over time or at a point in time. Now let us summarize the lecture. There are 5 steps to revenue recognition: identify the contract, separate performance obligation, transaction price, allocating the price, recognizing revenue. Next, a contract is an agreement between parties that creates rights, enforceable rights and obligations. Promise to transfer good and service that is not distinct from other goods and service must be combined into a single performance obligation. Next, transaction price has to reflect variable consideration like discounts and significant financing component. Transaction price is allocated in proportion to their stand-alone selling price of good and service. Revenue is recognized when a performance obligation is satisfied. This can be satisfied over a time or at a point in time. When a revenue is recognized over time, we use input or output method to measure progress towards completion. When performance obligation is satisfied at a point in time, we see whether the customer is taking the control of the asset or not. Then we recognize the revenue. Incremental cost of obtaining a contract are recognized as an asset. Cost to fulfill a contract are recognized as an expense. A contract asset or liability is presented in your financial statements when either party has performed in a contract. The difference between the revenue and the amount invoiced. Okay, so the contract asset or liability is the difference between the revenue minus the amount invoiced. If revenue is more, it's a contract asset. If amount invoiced is more, it's a contract liability. And a receivable is recognized when payment received is less than the amount invoiced. An entity is a principal when they are controlling good and service before it is transferred to the customer. A principal will recognize their revenue as a gross transaction price. An entity is an agent when it arranges another party to provide this goods and service to customer. So the revenue that they recognize is in a form of fee or commission that agent receives. An option or right to repurchase an asset gives rise to a lease or a financing arrangement, but the lease part will not be asked in financial reporting exam, only in its financing arrangement. Revenue cannot be recognized when there is a bill and hold arrangement until the customer takes the control of the product. Revenue is recognized in a consignment arrangement when the dealer sells the product to a customer or takes control of the product. Either dealer has to sell the product to the customer or dealer has to take controlship of the product. Then only you can recognize revenue under consignment. Next, there is one technical article that you have to read, that is IFRS 15 contract assets and contract liability on your ACCA website. Thank you for watching, and I shall see you in my next lecture. Next lecture is again a very small standard, that is IS2 inventory, the next item. And meanwhile, do not forget to watch my previous lectures. You can watch them under my FR playlist. All you need to do is just click on my playlist given on the right hand side below and get to my playlist. And do not forget to subscribe to my channel if you haven't subscribed. Thank you for watching.